Imagine, yeah. Imagine if someone came up to you, a random stranger came up to you and said, "Hi, I'm John Anderson, and I need to borrow a couple $100,000 to buy a home." What was the first thing that would run through your mind if someone came up to ask you to borrow a couple $100,000 to buy a home? That's what banks go through every day when strangers come up to them and tell them, "Hey, I want to buy a home." What factor plays in them lending someone money to buy a home? What factor tells you it's okay for you to loan out the money? Tonight, we're going to go over how credit is used to qualify for home ownership. What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to simplify home ownership. If it's your first time tuning in, do me a huge favor, hit the subscribe or notification button so you're notified every time we go live or post new content. We go live Monday nights at 9 p.m. and we post content daily on Instagram and TikTok. So if you're not following us on the other platforms, please go ahead and do so. Remember, this is an interactive live stream, so please ask a lot of questions. And tonight, guys, we are going to go over the two main factors that banks look at to qualify you for a mortgage. They're going to look at your credit, and it plays two major roles. Your credit score plays a major role in you qualifying for a home, right? A grade that shows the lender your ability to pay back the debt. Imagine if you were loaning out the money. You want to see a grade to see that person's ability to pay back debt, that person's ability to borrow that amount of money and what they're going to do to pay it back, right? And the second main factor, monthly credit debts, showing the lender what other debts do you have. Think about if you were trying to loan out a couple $100,000, you want to see what other debts do they have. Do they have a bunch of little credit cards? They have a car loan? Do they have big debts before you loan them that money? Even though they have great credit, what other debts do they have? And can they take on that responsibility with all the debt they have? Right? Before we get into these two factors, though, one of the most important things about getting a mortgage that people forget about and a lot of lenders don't talk about is your public records, right? So when a lender runs your credit, or when you run the borrower's credit, right? Let's say you are the bank and you ran the credit. You're going to look at public records, right? On the public records, you're pretty much going to see bankruptcies, short sales, and foreclosures. Depending on the program the consumer is going to go with, or you're willing to lend out the money, they're going to expect for that item on the public record to be seasoned after a certain period of time. For example, a Chapter 7 bankruptcy, a Chapter 11 bankruptcy, or a Chapter 13 bankruptcy, right? When you file BK, you're like, "Hey, I can't pay this debt, let it go." A Chapter 7 is a personal bankruptcy, a Chapter 11 is a business bankruptcy, and a Chapter 13 is a reorganizing of debt. See, if you're going with a VA loan or FHA or other government loans like USDA, right? After 2 years, you can purchase, right? Conventional, you got to wait 4 years. If you have a Chapter 13, you can buy after the first 12 months, after you made all your payments on time. With a conventional, after 2 years. If you have a short sale, which is on public record, which means you sold your home for less than what you borrowed. For example, if you owed $400,000 in your home and you sold your home for $300,000, which doesn't happen in a seller's market, right? Let's say you owe $300,000 and you sold the home for $200,000, right? You sold it for less than what you owe. So it's called a short sale or a foreclosure, right? You just let the house go and the bank took it back, right? Depending on which program you went with, your bankruptcy or your your bankruptcy, your short sale or your foreclosure has to season. Once you get the public records out the way, now let's focus on credit score, okay? Because it doesn't matter how good your score is. If you have those items on public records on your credit report, it is going to affect you buying a home. Doesn't matter if you have debt or no debt, how good your credit is, you got to deal with the public records right away. But now let's talk about the important factors about your credit score, right? Your credit score tells the bank your ability to manage debt, your behavior to manage debt. Of course, the higher score, the better. When a lender pulls your credit, right, they're going to go to a credit bureau, right? No matter who you run your credit with, they're all going to go to the three main bureaus, Experian, TransUnion, and Equifax to run your credit, right? These bureaus will give a credit score. But depending on who you're borrowing money from, they're going to pull a score based on that credit scoring model. For example, if you're going to get a credit card or a student loan, they use FICO score 8. So you can go to Experian, TransUnion, and Equifax, right? When you run credit, typically if you go out and get a credit card, these credit card companies will go to Experian, TransUnion, Equifax and tell them, hey, we need a FICO score 8 score before we loan so-and-so some credit, right? Same thing with student loans. They use FICO score 8, which is very common and popular. So if you go to Experian to run your credit, TransUnion or Equifax, right, and they run it directly, they'll typically pull a FICO score 8. If you go to a car dealership to get a car loan, they use something called FICO Auto Score. Experian, TransUnion, and Equifax will pull a FICO Auto Score. Of course, the most popular one is Credit Karma. Everyone wants to go to Credit Karma because it's free. Credit Karma uses Vantage Score 3 to run your credit. But if you want to get a mortgage, your credit bureaus have to pull a FICO Score 2, 4, and 5. Experian will pull a FICO Score 2. TransUnion will pull a FICO Score 4. And Equifax will pull a FICO Score 5. So when you want to get a mortgage, you have to have your credit pulled by 3 bureaus with the correct credit scoring model. So if you are serious about homeownership, you got to let a mortgage lender run your credit so you can get an accurate credit score. But if you don't want a mortgage lender to run your credit because you don't want to be sold, you can go to myfico.com. They're the only company that I've seen out there, not saying that they're the only one, but the only one that I've seen that will allow you to get a FICO Score 2, 4, and 5. It will be a hard credit pull. It'll cost you $60 a person. So each person that pulls it will cost you, if there's 2 people, it's $120. So either have a lender do it. You're going to have to get it pulled anyways, right? Either save yourself $120 or pay them or get it for free, right? Depends on how much heat you can handle from the lender. Now that you know you have a credit score, right? What makes up your credit score? So there's 5 factors that pull your credit, that make up your score, right? Factor number 1, payment history. Payment history is different with length of history. How long have you been on time? Have you been on time for a long period of time? You can't be on time, miss payments, be on time. That's inconsistent. They want to see payment history. That makes up 35% of your credit. It's really important for you to know these factors. The reason why, when you're trying to get your credit to a certain place to qualify for your loan, you want to make sure you get the lowest rate. And the best way to get the lowest rate is understand what dictates your credit, right? Payment history makes up 35%. Amount owed makes up 30%. Of course, you're borrowing hundreds of thousands of dollars. You want to have some good amount, right, that you've already borrowed, like credit cards, right? You want a $10,000 credit card or a $20,000 credit card or a car payment that's, $30,000, $40,000. That's why a lot of people have car loans first, okay? But remember, also amount owed, but also the balance that's owed. You want to have a low balance. If you have a $10,000 credit card, you want to keep it under $2,900. You want to keep it under 30% to maximize a good credit score. And now new credit makes up 10% of your credit. That's why when you 29 get all 3 for $30 from myfico.com. Thanks, Edward. I think the one for mortgage, the FICO score 2, 4, and 5 might be 60. They might have changed it to 29. Thanks, Edward. So, your credit score, right? Your new credit. So new credit makes up 10%. So you have new credit, you're paying on time. But if you get hard inquiries, this is where it hits your credit score, right? And also next is the length of credit history. The longer you've had credit history, the more it improves, okay? So if let's say you have four credit cards that are 10 years old, right? That means you have 4 credit cards that they average it out over the 4, right? That means you have 10-year-old credit. If you went out and you got a new credit card, you just got it, right? That they have to divide by 5. Let's say you have 4 credit cards. That's over 10 years old. That's 10 years old. You add the 5th one, right? Right now you have an average of a 10-year balance, a 10-year-old credit, 10-year-old credit. You add that 5th one. Now you have an 8-year credit, right? They divide by 5. So remember, if you have long credit history, going out getting new credit does bring down your score just for a short period of time until you start making that payment on time. Last but not least, the final factor is credit mix, right? The lenders want, or credit bureaus want you to have a mix of credit, okay? So they want you to have revolving debt, installment debt, mortgage debt, right? It's a mixture. It's not too big of a deal. It's 10%. But those 5 factors make up your credit score between 300 to 850. And remember, 850 being the top, right? But now you know what factors make up your credit score. What you can do is, if you're going to go through credit repair or you're going to go through a what if simulator, you want to attack the factors that make up the most of your credit, right? Payment history. That's why a lot of people talk about, if you add yourself as an authorized user on someone's account that has a long payment history, right, which makes up 15%, and they've been making their payment on time, which makes up 35%. That's why people talk about adding yourself as an authorized user on someone's credit, right? Make sure they have a long history and they've had payments on time for a long period of time. And next, of course, is amount owed, 30%, right? Sometimes you don't want to inconvenience someone and add yourself as an authorized user. Then pay down your debt. The more debt you pay down, the better your credit improves. Last but not least, new credit. You don't use you don't use new credit all the time, because if you get new credit, it brings down your length of your credit history. But sometimes you don't have enough credit. You might need to go out and get that credit card and start making your payments on time, right? Once you made your payments on time over a period of time, it improves your credit. But remember, hard inquiries does affect your credit. Length of credit. So when you have credit cards or cards you pay off, sometimes that brings down your history. So be very careful with that. But now you know what makes up your credit. So what you know what you need to do to keep your score up. Of course, credit mix, people don't go through that a lot to modify their credit. They go through the first four, right? Payment history, amount owed, new credit, and length of credit. That right there makes up your credit score. Okay. So now we know that. The next step is, what's the process of getting your credit report and your credit score? Number one, you need a hard credit pull. Make sure you have a mortgage lender or a service that use FICO score 2, 4, and 5 to pull your credit, right? If you want to know your credit score, you're not ready to buy a home, go to myfico.com, or, like I said, research different services. Make sure they pull a FICO score 2, 4, and 5, but you need that hard credit pull. Make sure you have all three scores. You don't want to have one. You don't want to have two. You want all three credit bureaus, right, to have all three scores. If you're an individual, they're going to use your middle credit score to judge your ability to pay back debt. You are graded on your middle score. For example, if you have a 680, a 700, and a 735, they're going to use the 700 score as your score to judge your credit. Okay, that's you as an individual. And if you are buying with multiple people, they've changed some of the rules, as some of you guys might know. In some aspects, or in some program, depending on the program, they're going to average out your middle score. For example, if you as an individual have a 600, a 700, and an 800, and your co-borrower has a 650, 750, or 850, they're going to take your 700, the other borrower's 750, and add it up and divide by 2. Average it out, which is 725. So depending on the program, talk to a lender. Hey, are they going to take my average? If there's multiple people, are they going to take the average middle score, or are they going to take just the lowest middle score, which is our next one, right? Some programs, they're going to take the lowest middle score. For example, if you have a 600, 700, and an 800, and the co-borrower has a 650, 750, and 850, they're going to use the 700 credit score to judge the profile on that loan, right? So they're going to grade you, hey, between these two people, we're going to go with the 700. With that 700 score is how they judge what interest rate you're going to get, how much you can borrow, what program you're going to go with. Okay, so it's really important for you to figure it out. So now we understand how much credit plays into qualifying for a mortgage, right? Now you guys understand why mortgage lenders need to run your credit. If you are serious about home ownership, you can't gamble and go with another credit company or a non-mortgage credit industry credit company and not get the right credit score. And now we know how the score is pulled. And now we know what makes up your score. And now we know what score they're going to use. The next step is, what score maximizes the best deal, right? What score are mortgage banks looking for? Depending on the program you are going with. If you're going with a conventional loan, you have to have between a 620 to a 760 to go with a conventional loan. And to maximize the best deal, you want to be in a 700 score or up, right? You're going to get the lower rate and the cheaper private mortgage insurance if you're putting less than 20% down. So you want to make sure that, right, you have a 700 or up to go conventional. Because if you have under 700, you can still go conventional, but the payment might be higher than the government loan, right? With government loans, they're more flexible. We're talking about USDA, VA, and FHA. You want to be between 580 to 680. 660's gonna optimize you with the best deal. Yes, with government, you can go under 580, but now you're going with a manual underwrite. Right now in a seller's market, banks are really looking, not banks, sorry, sellers aren't really looking at manual underwrites, right? They're looking for automated underwrites. And to qualify with automated, you want to be in 580 or up. 660 is going to get you the best deal, okay? With a government loan. If you're going to go with a jumbo loan, right, which is a loan amount above the conforming loan limit in your county, every county is different. You want to be between 680 to 780, right? But to maximize the best deal, you want to be in that 740 score. You might not like the payment if you are under 740 on a jumbo loan, okay? So now we know how to get, now we know how credit, now we know how they pull the score, what scores they need, right? We also know the score, how they generate the score, and now we know the score you need to maximize the best deal. So right there is the first factor of qualifying for a mortgage, what the credit score is. Now, the second factor, which is important on top of your credit report and your credit scores, how much monthly debt, right? What credit debt affects buying a home, right? So, of course, now you know the score. Think about it. If someone reached out to you to borrow money, right? You want to know, okay, what's their behavior of paying back the debt? Before you hand over hundreds of thousands of dollars to the person borrowing the money, or before the bank hands over hundreds of thousands of dollars to you to borrow the money, they want to know, hey, wait a minute, I love the score, everything looks solid, but what type of debt do you have, right? What type of debt does the borrower have? Can they handle a couple $100,000? They can. How much can they afford to pay monthly to pay the bank back or you back for borrowing that money? So how monthly credit debt affects buying a home is really important, right? Some people are, oh, I have great credit. Why can't they just loan me the money? I make all my payments on time. Remember, you're borrowing hundreds of thousands of dollars. They want to know that besides the grade, that what other debts can you have? Can you handle more debt? And the way they do that is they want to go through your debt to income ratio. If you haven't seen our video on debt to income ratio on your mortgage budget yet, right? Make sure you click the link below and check out how to budget for a mortgage payment, right? So, of course, it's your debt to income ratio. I don't use that word a lot. I actually used to use a lot, but I know a lot of people don't know what DTI is. It's your budget, right? The more debt you have, the less buying power you have, right? So if you make $10,000 a month, it's just an example, right? You typically take your monthly gross income and you times it by 50% on a conventional loan, 55% on a government loan, and 43% on a jumbo loan, right? But this is an example for a conventional. If you make $10,000 a month, so whatever your monthly gross income is, you or whoever else is going on the loan, take the monthly gross income times it by 50%, right? Congratulations, Rick G. So if right here is 10,000, you times it by 50%. That means your max payment that you can afford for your mortgage payment and all your credit debts can exceed $5,000 a month. I'm not saying that you should go to 50%. I'm saying the banks on conventional will loan you up to a $5,000 a month monthly payment, right? The less debt you have, the better. But let's say you have no debt, they'll let you go up to 4,500, 45%. But with debt, 5,000, okay? So if you had $1,000 a month in debt, you can afford a $4,000 mortgage payment. $1,500 a month in debt, a $3,500 mortgage payment. $2,000 a month in debt, $3,000 mortgage payment. $2,500 a month in debt, $2,500 mortgage payment. Of course, as you can see, the more debt you have, the less home you can afford. Or you're going to come in with a big down payment to keep the payment where it needs to be under the debt to income ratio cap, depending on the program, to qualify to buy, right? I did another example for you right here. How to afford $50,000 more home, right? So it's really important for you to know your monthly debts, and we'll go over that in a second, so you can qualify for more home. I took a $50,000 home. I know there's not that many homes in the United States for $50,000, but there are areas where there are $50,000. But even if your home is not $50,000, I just use that as increment. A lot of times people qualify for about $50,000 less than what they're happy with, right? Some people need that extra $50,000 or that extra $100,000. So on an FHA loan, which has a higher payment than conventional, right? If you have a really good credit, you got to go conventional. That's another one of our videos. But let's say, worst case scenario, you have to go FHA. So on a $50,000 home, 3.5% down, if I took the principal and interest, PMI, so I added the PMI to worst case scenario, right? If rates are at 3%, right? $340 a month will get you $50,000 more home. When you look at your debts, if you pay down $340 a month in debt, That will give you $50,000 more home. If rates are in the 4%, you would have to pay down $370 a month in debt to get you $50,000 more home. Look at that 5%, right? If interest rates are at 5%, you would have to pay $400. If rates are at 6%, $430. If you're trying to qualify for $50,000 more home, right? You can either drop the purchase price $50,000, which no one likes, come in with $50,000 out of pocket, or pay down some debt to eliminate that $340 a month if rates are at 3%. If you're trying to qualify for $100,000 more home, you would have to eliminate $680 a month in debt, right? On a rates are at 3%. If rates are at 5%, you would have to eliminate $800 a month in debt to qualify for $100,000 more home. Okay, and these are the debts when they run your credit that the lender's going to count against you, right? These are the debts you want to focus on. Revolving debt, your credit cards, anything you pay off, you can use it over and over again, is your revolving debt. Installment debt, right? Things that have an ending to it, right? A car purchase, okay? A car lease, right? If you finance jewelry, furniture, electronics, or appliances that have an end date, those are installment debts. Mortgage debt, right? If you already have a property, right, and you got to count that property against you, right? Mortgage debt is categorized differently because mortgage debt, there's a revolving part. That's like a home equity line of credit if you have a line of credit, or there's an installment, right? A 30-year fix, 25-year fix. So there's revolving, installment, and mortgage. The fourth type of debt is your collections. Yes, we hate to talk about it, but they're out there. Collections, right? You do not count charge-offs against you or medical collections. But regular collections, yes, you can throw the charge-offs and the medical collections out the window. And there's another debt they do count against you that sometimes is on your credit report, sometimes is not. Court-ordered debt. If you have alimony, child support, or if you lost a lawsuit and you have to pay money monthly, right? Those right there are included in your debt-to-income ratio or your mortgage budget. And last but not least, government debt. If you owe money to the IRS, that debt will count against you to qualify for a home. Doesn't mean if you owe money to IRS, you can't qualify to buy. That monthly payment does count as debt. All right. Same thing with if you owe back child support, you can still buy. You just have to count that monthly debt. All right. So now that you know the debts that count against you, the next step is to verify your monthly credit debts. Right. A lender has to run your credit. If you are serious about buying, the sooner you want to buy, you want a lender to run it. But if you're like, hey, I'm a year, 2 years from buying. If you're not in a position to buy, do not buy. But if you're in a position to buy, have a lender run it. But if you need to prepare yourself, go through Credit Karma. I do not like the credit scores on Credit Karma because they use Vantage Score 3, but you want to see your credit utilization, right? What your limits are, what your balance are, what the payments are, right? If you need to make a list of it, see what debts you can attack, right? What debts are going to fall off by the time you're going to buy so you can not count that debt. If that debt is under 10 months old, which we'll go over in a second, you might be able to omit the debt. Did you co-sign for somebody, right? You want to go through your debts. If you're not ready for a lender to run it, use Credit Karma. Remember, if you and your spouse are buying a home and it's a car that's on both your credit, you only count it once. You don't have to count it twice. Same thing if you're an authorized user on someone else's account, that monthly payment does not account against you in your debt, all right? So you want to verify the debt with the lender or use myfico.com or use Credit Karma, right? It depends on where you are in the home buying process. Once it's verified, now you want to tally up your monthly credit debts, right? So if you have time, go to what'samortgage.com, download our ultimate mortgage guide. In our guide, we have our monthly debt worksheet. You want to tally up your credit cards, your car payments, student loan, installment, collection, mortgage debt, court ordered, and government. Tally it up. Write down the name of the debt, write down the monthly payment, write down the balance and how much left you have on it, right? So you can start playing and manipulating and see what debt can I cancel or eliminate to qualify for more home, right? So once you make a list of all your debts and you can see, okay, I know what I'm going to attack, right? What debt can I get rid of? Where are interest rates at? Okay, what debt can I get rid of to qualify for $50,000 or $100,000 more home, right? Once you have your list of your debt, you want to match up your debt to income ratio, right? We want to go back and take your monthly gross income and times it by 50% if you're going to go with a conventional loan, 55% if you're going to go with a government loan, right? USDA, FHA, or VA. Remember, if you have no debt, some people don't have any debt. The max can go up to is 45% max debt to income ratio on a mortgage payment, right? On a conventional or government loan. Remember, if you're going to go with a jumbo loan, your max is 43. right? Even with debt or no debt, the max is 43%, right? So once you're like, I make X amount gross, let me times it by 50%, right? That's my number. Let me subtract all my credit debts, all my government debts, all my court order debts, right? Once you eliminate your debts, whatever's left is your max mortgage payment. You're like, man, that payment can't get me a lot. Okay, let me work backwards now. What debts can I eliminate? Because I have a threshold, right? Take your monthly gross income of everyone who's going to be on the loan, times it by 50%, right? What debt? That's when you start playing the game. What debts can you get rid of, right? You know your monthly gross income. You see a list of your debt. Cool. This is my max mortgage payment I can get up to, but this is what I have now because I have my debt. What debt can I get rid of? Let me attack the debt, right? And this is what lenders do all day, right? It's not rocket science, but it does take time. That's why you gotta watch our videos, all right? So check out our videos so you understand how to qualify for more home, okay? So you have the tally, you eliminate those debts, and you qualify for more home. And here are now, of course, finally, the rules of tallying debt, okay? Sometimes it's simple, sometimes it's hard. Here are some rules, okay? Whatever monthly debt is on your credit report, you want to add that. That's added to your debt to income ratio, okay? If there's a payment there, you add that payment. Unless it's a medical collection or a charge off, you leave it alone, okay? If there's a payment, you add that payment except for medical collections and charge offs, okay? Now let's go with collection with no payment, right? So if you have collections with no payment, if the total of all your collections, the balances are under 2,000, leave it alone. If the balances are, let me do the math really quick before I say something here. If the balance is over 2,000, right? Or if it's 2,000 or more, you would add $100 a month to your debt to income ratio. So if you had $4,000 in collection, you add $200 a month to your debt to income ratio. You would add the $200 as the tally, right? So take the balances under 2,000, leave it alone. 2,000 or higher, take the balances, times it by 5%. That's what added, okay? Student loans. If there's a payment on student loan, you would add that payment to your debt. Let's say there's no payments, okay? So your student loan can be in different positions. If your student loan is in deferment or forbearance, you would take the balance, times it by 0.5%. For example, the average student loan is $30,000. If it's $30,000, you would add $150 a month to your debt to income ratio. That would be on your tally sheet, right? On the worksheet. If your student loan is in income-based repayment, whatever the payment is, you add that to your worksheet. But if there's zero payments, then you add zero. Okay? So if there's zero payments, you add zero. That's kind of like a hack right there. You have a student loan and it's an income-based repayment. If it's zero, they add zero. So that's how the student loan rule works. Okay? Also, now the cosigner. This is how it works if you co-sign for somebody. This happens a lot. If you co-sign for somebody, right, they have to make 12 payments first before you have a chance to omit the payment. That's why when we make a list of your debts, right, on that tally worksheet, you write down how many months are on it, how many months are left. If they made it less than 12 months payments, you can't omit the debt. They would have to make more than 12 months payment before you have a chance to eliminate the debt. If you're going with a conventional loan, right, you can omit that debt, right? This is more for installment debts, for a car loan or something you help them finance, right? If they made 12 payments and you're going conventional, you can omit the debt. But if you are going with an FHA loan, they're gonna want to see the paperwork on the car, on the loan, right? If you are the main person on that car, you cannot omit the debt with an FHA loan, with a government loan, right? You have to be the co. You can't be the main. If you're the main and the other person's the co, you cannot omit the debt. All right? So that's how the cosigner rule works. But let's say you co-sign for a mortgage, right? If you co-sign for the mortgage, you're going to need 12 months, right? Same rule. But after 12 months, right, as long as you didn't write off the mortgage interest and you can prove that you don't live in the house, you can omit the debt, right? As long as they're making payments on it and you didn't write off the interest. I see a lot of people, because they help someone co-sign for the house, they want to write off the interest and get some type of benefit out of it, and now it affects them qualifying for the house, right? Even though the other person made the payment, you cannot omit it if you wrote off any of the interest. So be very careful doing that. And last but not least, on the tally rule, installment debts. If you have an installment debt less than 10 months old on a conventional loan, you can omit the payment as long as it's not a car lease. Okay? On a conventional, less than 10 months, you can omit the payment. Okay? If you're going conventional, if you're going FHA, that payment has to be less than 5% of your gross income. So if you make $5,000 a month, that payment, if it's over $250 a month, you cannot omit it. Okay? So it's very important that you know this so you don't go out there, oh, I can omit this or I can omit that. Right? So that right there is the second factor in your credit that is used to qualify you for a mortgage. Of course, the first factor is your credit score. Now we know your credit score. Of course, next step is knowing your credit debts so you can see how to increase your buying power. Hopefully this video brought you a lot of value. Do me a huge favor. Save this video, share this video, and like this video. If you're not following us yet, definitely hit the subscribe or notification button so you're notified every time we go live or post new content, guys. All right? Thank you so much for watching the show. Let's get some Q&A. What's going on? What? Okay, what's going on, Raska? What if I missed a payment by 1 day? My car payment is due on the 1st and I paid it on the 11th. So, Raska, if you miss your car payment, as long as it's not over 30 days late, you are fine. But once it's 30 days late, that late will hit your credit report as a late. So typically you will have a penalty to pay. So make sure when you pay that payment, you pay the penalty too. Some creditors, if you make the payment and you don't pay the penalty, they'll still roll it over as a late. So make sure you pay that penalty. Okay? You're fine, Raska. Edward, $29. Get your FICO score from My FICO. Yes. I like My FICO. They use FICO score 2, 4, and 5. When they judge your credit, definitely there's no hard inquiries. Ooh, really, Edward? Didn't know that. Did not know that, Edward. Typically, yeah. What? Didn't know that. Thanks for the heads up, Edward. Gabby Gutierrez, what's going on? Rick G, congratulations on finally closing escrow. Congratulations. Edward Min, what's the lowest qualifying score for GSFA? So, Edward, if you are going with GSFA, if you want to go with the conventional version, you can go down to 640 for the conventional. But the PMI is going to be pretty disgusting. For it to actually pass DU, desktop underwriting at 640, is very rare, right? You want to be if you're going to go with the conventional version, you want to be 700 up to get a good deal. Typically, if you're under 700 and you would go FHA. For the FHA version, you want to have at least a 660 score or better, okay, to go FHA. Hopefully that helps you out there, Edward. So 640 conventional, 660 FHA. I don't recommend the conventional GSFA if you have under 700. All right, hopefully that helps you out. Lisa Long, can you omit monthly installment payments if I have 4 to 6 months left? Yes, you can, Lisa. If you're going conventional, you can omit it. If you're going to go FHA, the payment has to be less than 5% of your gross income. And remember, you cannot omit a car lease. All right, hopefully that helps you out. All right, guys, I really appreciate everyone who stayed on. Thank you, everyone who watched. Please do us a huge favor. Save this video, share this video, and like this video. And we want to end all our episodes with our attitude is gratitude. Without you, there'd be